Hi guys, welcome back to Compound and Everything. My name is Chris and this is the channel that discusses all things investing, finance and business. If you're interested in learning more about growing a long-term successful portfolio, please feel free to press that subscribe button and you can follow our journey. I think we've all had that point in our lives where we wish we could go back and give the younger, less experienced investor in ourselves a tap on the shoulder and just say, no, don't do that. So, in today's episode, we're going to be talking about the top 5 mistakes that new investors often make, and I'm going to also share with you the best ways that you can avoid them, hopefully saving you a little bit of money and some sleepless nights. Stick around. Now, of course, just like the picture says, I'm not a financial advisor. This really is just handy information here, and you really should do your research and seek professional advice before making any investment decisions. So let's get straight into it. Mistake number 1. This is a hard one sometimes for a lot of people because you want to get into the stock market to try and make a little bit of money and to try and get ahead in life. But the first thing you want to do is not invest money that you can't afford to lose. So, what am I talking about here? Well, you're either going to be borrowing money to invest in the stock market or you're going to be using funds that really should have been going towards the cost of living. Both of these things are just going to make it more difficult for you to invest long term because when you do come across those hurdles in life, you're going to be tempted to pull that money out and use it to pay for the cost of living or pay back the debt. And look, maybe you think that you can make a lot of money and then you'll pay it back after your 200% gain on that amazing penny stock that your uncle told you about. But more often than not, you're just going to come out at a loss. This really leads back to a point I made in my last video regarding emergency funds and putting one in place. They help keep your investment plan on track. They're a sound investment themselves and they keep your stress levels down, which is probably the most important thing in long-term investing. If you're interested in watching that video, I'll post the link in the description below and put it somewhere up here, wherever that goes, and feel free to check it out. Mistake number 2, the one I come across more often than any other, especially with family and friends. The name of this channel is obviously Compound and Everything, so it's fair to say that I'm a pretty big fan of compounding interest. It's also safe to say that most people assume you need bulk coin to get into the market, or they assume cash is the safer option, and this really just isn't the case. Due to inflation, cash steadily loses its purchasing power at a rate of roughly 2% a year, which means over the next 30 years, uninvested cash will lose more than 50% of its potential value. Not to mention, time and time again, we see the humblest contributions turn into the most substantial nest eggs over a long period if invested in the market. I'm often telling my family and friends that have children, compounding interest could change their kids' lives, and even potentially their kids' lives. And most of them are just too scared or assume they can't afford it. So let me give you a 30-second rundown on why that's wrong. Let's say you start investing $25 per week for your children from birth in a safe long-term investment like a low-cost index fund. They would have roughly $185,000 each by the time they turned 30. Did you see what happened there? Over a 30-year period, you actually invested $39,000 out of your own pocket in cash, which ended up compounding into $185,000. But the magic, of course, is really in the next 10 years. Because over that period, that $185,000 turns into almost $500,000. That is compounding interest truly at work. The more you let it run, the more substantial your gains are going to be. And if you think that's great, you should see what happens after 50, 60, and 70 years. It really starts to have a significant compounding effect. The great thing about compounding interest is that it doesn't require a large amount of money to get started. You literally, like in this example, could start with $25 a week. And in 30 years, you're going to have $185,000. And in 40 years, you're going to have $500,000. So look, don't get too caught up in trying to figure out everything from this tiny snippet regarding compounded interest. We're actually going to have a dedicated video either next week or the week after completely breaking down compounding interest and trying to break it up into categories that might help you in your situation build financial freedom over the next 20, 30, and 40 years. So if you are interested in that video, once again, feel free to comment below. And of course, if you haven't already, please press the thumbs up button. It helps out with the YouTube algorithm. Mistake number 3. This one hits a little close to home, and I'll sort of get to that at the end of this point. CFDs are a little different to, say, using bank finance to trade or invest. CFDs allow you to take margin or a loan against the balance of your cash account or investments. That sounds great, right? Well, not so quick. In some cases, for larger portfolios, you might have access to millions of dollars via margin lending. And of course, like trading in general, the risk is not in the upside, it's in the downside, because your investment can be significantly outweighed by the losses that can be incurred if that position were to go down. Let me give you an example of this. Let's say that you had $10,000 in your trading account. Depending on the broker, they may leverage your trade up to or over 5 times your capital value, meaning that that $10,000 might be worth $50,000 or even in some cases $100,000. The problem here is generally not in the upside, like I said. It's when you buy a stock and the price goes down. Your losses can outweigh your original investment of $10,000, and not just by a small amount. There is actually almost no limit as to what your losses could be. Some of the best examples of this recently would be Robinhood users in the USA. We've seen accounts placing down tiny amounts of $100 to $500 and leveraging tens of thousands of dollars in their accounts. Here's somebody that was down $57,000, and here's another one that was down $22,000. So not only can you actually lose more than when you put down, which is bad enough in itself, in some cases you can actually have no control over the trade itself. And this is called a margin call. It's where your broker will contact you and they'll say, look, you need to top up your account because you aren't covering the losses that you're experiencing. Meaning that your position might be $15,000 down and you've got a $5,000 gap between the $10,000 and the $15,000. So what they'll say is, look, if you don't pay the $5,000 to us right now, we're going to close the trade. And you're going to think, oh, crap. Once they've closed that trade, not only are you going to be left with a sore head, you're going to be left with $5,000 owed to your broker. Not a position you want to be in, trust me. The reason I say that is because it still pains me to say that I myself experienced this as a rookie investor. If you are interested in knowing how I was margin called down $50,000 at 3 a.m. in the morning on, I think, maybe a Wednesday morning, type a comment below. And if enough people are interested, I'll make a video about it. It's still something that is quite raw for me, even though it was years ago. But I think for the learning experience, it would be valuable for everybody to firsthand hear how that type of trade can get way out of control. So yes, leave a comment below if you're interested, and I'll put something together. Mistake number 4, something once again I've experienced myself, which was trying to time the market. Countless studies have shown that trying to buy at the bottom and sell at the top is incredibly difficult, if not impossible to do consistently. And trust me, I have tried. There are many reasons why tactics like this, attempting to time the market in such a way, frequently fail. No one can accurately say how long each market cycle will last, if it started, ended, or even if we're in one. Sure, I mean, we can guess that maybe 2 months ago was the end of a bull cycle. Maybe we're at the bottom of a bear cycle. Maybe we're halfway down. Maybe we're going to have a V. Maybe we're going to have an L. Maybe we're going to have a U. Nobody knows. It's pure speculation. So, let me tell you why 99%, literally 99% of my portfolio is based around not timing the market. If you missed the best 5 days on the Australian stock market in the last 20 years, your overall return would have been cut by 40%. That's a staggering amount. And that's only the difference of missing 5 of the best days in that 2-decade period. Now, once again, the same thing happens when you're trying to predict the market over a short period of time. It's a very dangerous strategy for new investors to take up. Now, I'm not saying that you can't dabble in a few speculative plays. Go for it. We all have. Anyone that says they haven't is a liar. But it's better to keep the majority of your portfolio and a significant majority of your portfolio dedicated towards long-term performing assets that you don't have to worry about buying and selling on a daily, weekly, or yearly basis. Something which almost all accomplished investors are likely to tell you is that key behind their success is in building their financial freedom has been their ability to ride out market gyrations and stay focused on their long-term goals. Focusing on the long term is a less stressful way to invest, as you're not having to always second guess each market development day by day. By removing unnecessary emotion, you can avoid making the expensive mistakes which overreacting often leads to. Mistake number 5, which is not thinking for yourself. As a new investor, one of your biggest challenges in a digital world is steering clear of the herd mentality and not following the crowd. You've got sites like Facebook, Reddit, Twitter, YouTube, Hot Copper, where there are people on a daily basis trying to force information or a stock into your portfolio that you previously may have not have been interested in. In my opinion, the best thing you can do is do your own research, take in all the information you can online. I'm not saying don't go to Facebook, don't go on Twitter, don't go on Reddit, or don't go on YouTube. I'm simply saying absorb that information and then make your own decision and be comfortable with it. Look over balance sheets, understand the company, like the company, figure out if they have a moat. All of these things are important. And if you can do that and you want to invest, then go for it. That's great. And if you were wrong, it doesn't matter. You still made the right call. Guys, thank you again for being here. I really appreciate you lasting all the way through this video. I know this is the part where everyone walks away, and fairly enough, but please press the subscribe button and smash that thumbs up button. It really helps the YouTube algorithm and it helps out this channel. I've also left some links below to my favorite investing books. I'm actually going to have a video about that somewhere down the line, but I'm not sure where we are at that point yet. So feel free to click them and check them out. They are affiliate links, just a warning there. I've also left a list of the equipment I'm using because I did have a couple of questions on Facebook. So thanks again, guys. It's been a lot of fun so far. I appreciate the support we had in the last video. We've had over 500 views and 50 odd subscribers, which is just great for the first video. So thank you so much, guys, and I'll see you next week. Cheers.